everyone, welcome back. So check this out. We have lost over $11 trillion globally since 2022 and beginning of 2022. And this is a worst losing streak for global stocks since 2008. But the bad news is that we are still in it and it may continue for a bit longer. The research that I'm about to share with you suggests that. Anytime we see a bounce or a green day, we start to think that maybe this is the time that we are going to get out of it and we will recover. But the truth is, we will recover from this mess. Yes, eventually we are going to recover, but not with these dead cat bounces that we see over a Fed news or if a positive news comes in the market. The sentiment is at all-time low. I don't care if it's Tesla or SoFi. They all live in the same market, and a bullish news about more institutions holding it or the CEO is buying more stocks can only take it up so much, because then the market pressure brings it down. I'm down massively and all I see is a sea of red in my portfolio, and I would love to turn things around, but this is far from over. Let me share some data and some chart that suggests that we are going to see more red in the coming days, and I'm sure you are also feeling the pain, and I don't want to be that channel that always talks about the market crash or the S&P is crashing or the market is going down. But the research or the chart, I love the data, I love the research. More and more I read, more and more I see. I think that I need to be prepared for my portfolio, and that's why I'm sharing with everyone. Again, it's my personal opinion. The things can turn out tomorrow. Nobody has a clue. So let me share some data with you and let me go over a few things that I see in the market or what is being reported right now. So check this out. This is a S&P 500. I'm gonna actually increase the chart here. This is S&P 500 index weekly, and this is moving averages, which is simple 200 average on the chart that has been plotted. Right here is the moving 200-day moving average. Okay, and pay attention to this. It says S&P 500 has further downside before testing crucial 200-week moving average. I pointed out few things over here from the research right here. So this was 1987. We had a market downturn. This is 1990, which is way before our time when we were trading. So let's talk about the dot-com bubble to 2000 and 2002. So in 2000 and 2002, the S&P 500 dropped below the 200 moving average and stayed below the 200 moving average all the way from 2000, the dot-com bubble, all the way to 2003, towards the end of 2003, and that's when it crossed. In 2004 is when it crossed the 200 moving average and it came above it and it took a flight. Then let's talk about 2008 and 2009 crash. In 2008 and 2009, we saw the S&P 500 drop below the weekly 200 moving average and stayed below till about 2010, 2011 right here. And then it retested in 2011 the 200 moving average. Then it took a flight up and then it crossed 2000 level right here for S&P 500. And in 2016, when we had that market downturn, right here we saw the S&P touch again the 200 moving average. Then back in 2018, when the Fed all of a sudden came out and said we're going to increase rate, and then it touched the 200 moving average again. And then after that, it kind of took a flight up. In 2020, when we had the COVID crash, it dipped below the 200 moving average, but then immediately recovered. And we know what happened after that. We had this huge COVID boom in the S&P 500, where it touched the all-time high of about like 4,800. So we are in this right now. This is 2022. Okay. The weekly chart or 200-day moving chart suggests that we have more downside right here all the way to about 3,500 level right here for S&P 500 before it will test the 200 moving average. And this is critical. It's going to test the 200 moving average. They're not suggesting that it's going to bounce off like it has in 2011, 2016, and 2018. It can come down to 200 moving average and can test or remain down the 200 moving average for a very long time, as we have seen in 2008 all the way from 2008 to 2011, and then in dot-com bubble from 2000 all the way to 2004 before it crossed the 200-day moving average. So this is a very critical piece of information or a critical chart to keep in mind, because we know that we cannot time the market, but we can time our trades. And everybody is talking about buying the dip or investing in good companies. I've also shared in this channel that there are top 5 companies for me that I'm investing in, and I plan on DCAing in those companies. But if S&P has more room to go, then I feel that DCA strategy can also be altered. Altered means that, okay, if you were planning on DCAing 10% every week, how about 5% every week too, so that you can spread it out and see if S&P will test the 200 moving average. Now, there is no guarantee that you are going to get to the bottom because S&P can take a flight up and can go to all-time highs. But again, stock market is all about future prediction, not what happened in the past. So predicting the future, looking at the stats from the past tells us that S&P still has some more room to go. I'm going to share another chart with you. This is a chart that basically talks about S&P 500 index and how many members of S&P 500 that are in their new 52 lows. This is a very critical chart and very important chart in my opinion. So look over here. So the white that you see is percentage of members with new 52-week low and percentage of member with new 52-week high, the blue one right here. If you pay attention to this chart, and this is again the different events that happened, and basically that shows about where we are in terms of currently where we are, which is right here on S&P 500 chart. So if you notice over here, this is sovereign debt crisis that happened in 2011, and we touched all the way down to around 40% level right here when S&P 500 members were in 52-week lows, okay, 40% of them. Then back in 2015 and 2016 when the S&P dipped briefly, then this is Fed tightening in 2018, and at that time about, I would say, 50% of S&P 500 members hit the new 52-week low, which is again important. Then we had this COVID crisis that came out of nowhere and shocked everybody. And in this, we had over 65% of companies in S&P 500 that touched their new 52-week low. Right now in 2022, this is where we are, and we have about close to 25% of companies that are in their 52-week low. Now, of course, yours and my portfolio are saying something else. I mean, majority of the stock that we are invested in are at all-time lows. But if you look at overall S&P 500, we are far from over from what I'm seeing in these charts. So this is a very simple chart and a very simple metric to kind of base your decision on DCAing. I mean, again, nobody can time the market, and we are seeing over here that according to this chart, we still have a lot of room to go, because this is only equal to 2015, 2016, and that too was about like 25%, but we are not even at 25% right now. We are still far from here. And if anything like Fed tightening that happened in 2018 or the COVID crisis that happened in 2018, or we are talking about right here the 2008, right here we can see the 2008 crisis we had, where this was the biggest one, where we had almost 80% of the companies in their 52-week low. So some of them are saying this is worse than 2008. I really hope not, because if that's the case, then we have a long way to go. So I feel that we are in this weird market condition for a very long time. And the weird market conditions is that anytime we see a green, anytime we see that market is going up, we feel that there could be a turnaround. And I've seen some people go and buy calls right away on a green day, thinking that, you know what, the next day is going to be green as well. We are in this run, we are going to make more money because of options and stuff like that. And I always have shared with my Discord members, again, if you want to be a part of that group, links are in the description. So I've shared with my Discord members that, hey, do not spend any money in options. I could be completely wrong, and it's entirely, it's my interpretation of the market that I will not waste any money in options because I'm burning right now in options. I would rather buy the company shares, because if I buy a company share, let's say that some of the companies are in deep value right now, and if I buy a company share and if they go another 5 to 10% down, that is a paper loss for me. 10% down right now from where I bought it is actually not bad if you really look at it, right? I mean, we are down almost 40, 50, 60, 70% in some of our positions, which is really hurting right now. So 10% more down is not going to break the bank. But if you buy options, that can completely lose 80% of its value within like a month, if depending on how long of an option you played. So this is what I'm doing, again, my opinion, that I will not play any options right now until I see the sentiment change. I was just reading an article yesterday on Wall Street Journal. They were talking about how people are using calls to hedge. They are not being bullish. They are basically using calls to hedge, and they are looking for a turnaround. The put to call ratio on MSCI index, or MSCI, yeah. The put to call ratio is still very high. That means there are more puts that are being bought and sold as compared to calls. but just a simple green day makes people buy more calls, which is a wrong approach in my opinion, because if you're buying calls on a green day, you're absolutely, in these market conditions, you're absolutely setting yourself up for losses. And you can get lucky with one or two stocks, but you know what that does, right? I mean, you get lucky in one or two stocks and you make it that habit. You're like, oh, you know what? I got this. I'm understanding the game. And you start buying more and more shares and more and more calls. And then what happens? Right? I mean, a major red day comes and you lose all of it. All the gains that you made, you were happy about it, 15, 20, 30% gain, and you lose 80% right away. So, and trust me, it has happened with all of us, because we all want market to turn. We all want market to do better. But that's not the case right now, and we are witnessing it. I mean, yesterday was a major green day. Everybody was very excited. There was a new enthusiasm in the market, and this morning more China numbers came out, and then now the stocks are struggling to even maintain the yesterday's level. So this piece of information was very critical and very good for me to kind of put the noise out and focus on what can we expect. Even Elon Musk mentioned in the podcast that next 12 to 18 months we are in this downturn, and these dead cat bounces are only going to last for so long if the sentiment in the market is all overall negative. So I just wanted to quickly share this information and share the research. This is some very good information, so I really hope that you will take it in for what it's worth. And also, again, my opinion only, not a financial advice. Thank you so much for tuning in, and if you like the video, then make sure to give it a like and also subscribe to our channel if you're new. And for more one-on-one conversation, consider joining our Discord and Patreon. Links are in the description below. And take advantage of Moomoo. I use Moomoo for my charting and stuff like that. I really like it. They have this 5 free stock right now deal that's going on, and the link are in the description below. So definitely take advantage of that. I've opened my account and I'm loving the charting and all the things that they provide. Thank you so much for being here. Until next time, you all have a sparkling day.